It's now my pleasure to introduce the next session, which is What Should Business Look Out For with a Changing China? And it's my pleasure to also introduce two of the most perceptive analysts on China who have also interacted with our part of the world and been at the summit in previous years. They're both speaking to us today from the east coast of North America, where it's their Sunday evening. So thank you very much for breaking into your weekend. Our speakers are Raymond Yeung, who is Chief Economist Greater China for ANZ. He'll then be followed by Pulitzer Prize winning journalist Andrew Browne, who's now a partner in Brunswick Group in New York. Both are regular commentators on Bloomberg and elsewhere. I'll first introduce Raymond. Raymond's covered China's economy for more than 25 years. His provocative ideas and non-consensus market calls have garnered a strong following among ANZ's clients who range from central banks, corporate treasurers and portfolio managers. He leads an award-winning team based in Hong Kong and Shanghai. He has a PhD from Queen's University in Canada and speaks to us from Toronto, where he's been on holiday. And his topic is China's regime shift. Over to you, Raymond.
Thanks, Fran. It's my great honor today to participate in this China Business Summit. It's been years since I've been to Auckland. I think it's 4 or 5 years ago. And look, the reason I really like to participate in this conference this time is because it's the right time for me to share our view about China, because we do see some regime shift that is happening, not just about China, but all over the world in terms of the international economic order. I'm speaking to you, here in Toronto because I'm currently still on holiday. But the fact was that this is my first business trip in 2.5 years. So lots of the clients here in this part of the world, in New York, in New Jersey, and in London, asked me to come here to share their view with them. And especially with 3 key areas that they are very concerned about. If you don't ask me what happened in the past 5 years, that is highly relevant to China is a couple of shocks. First of all is the trade war that happened in 2017. And that's a very defining moment, I would say, in terms of Chinese economic and trading relationship with the US. Secondly is COVID, as you all know. That had started back in early 2020. There's about 2 weeks I was in Shanghai. 2 weeks before Wuhan, I was in Shanghai, and that's my last business trip from Hong Kong. Then the third one, of course, is pretty recent that happened pretty recently is Ukraine, and I think that these 3 events are defining some of the changes that what we are expecting over the next. Not just about 5 years, but also decades down the road. I'm by profession a macroeconomist, sitting at the dealing floor, work in the financial markets, looking at both the cyclical and also structural change of the Chinese economy, and also that that I'm an economist. Even though I know that I'm probably have 10 to 15 minutes to share my view, I do prepare some of the slides to you. And if the organizer can help me to share some of the slides and charts to the audience, that would be great. Otherwise, I can keep speaking. As an economist, I can talk about the Chinese economy 24 hours a day and 7 days non-stop. But look, you know that I prepared some of the slides now, and the title is called Regime Shift. And if we turn to the next slide, that I probably be easier to share some of the view about the China economic outlook. First of all is our cyclical view. And we know that, as Ambassador Wang just alluded to, in the first half of the year, China managed to get a positive growth, especially in the second quarter. We still have 0.4% of real GDP growth in the second quarter, despite the lockdown in Shanghai and Beijing and some other cities as well. But it's probably that I would think is a good outcome, ultimately, to manage that positive growth. But at the same time, I think the best way to characterize Chinese cyclical growth is not looking at the GDP number, as we all know that the GDP number tend to be very smooth. So in the markets, what we're looking at usually is the what we call the Li Keqiang Index, the name, after Premier Li talk about that he observed 3 indicators, and that gives you a pretty good idea how the business cycle is evolving with the boom and bust over the past 10 or 15 years. And the ups and downs of this Li Keqiang Index basically tell you the growth momentum and the cyclical growth pattern of China in the last decade. That has a strong correlation with credit expansion. And in the market, in financial market, especially in the trading community, they track these credit impulse indicators closely, because that tells you how the economy will be heading to over the next 3 or 6 months down the road. And that's strongly correlated with this Li Keqiang Index. And look, you see that every time China wanted to boost growth, and with lots of government stimulus or some of the relaxation policy towards the housing market too, will follow by a couple years of slow growth. So even though our house call now for China is that the GDP will still grow by 4 percentage points in 2022, but at the same time, what we're expecting is that China will probably start to deleverage the economy, because after 1 year of strong credit impulse, it's typically followed by a few years of slowdown because of the credit deleveraging over the next few years. So overall, what we think is over the next 5 years, then China will probably manage to grow by 3.5% to 4.5%. That would be a growth pattern what we expected over the next few years. And now this is a cyclical view, of course, that it doesn't mean that this is a bad growth. I usually tend to tell my clients that a low GDP number isn't necessarily a bad outcome. To some extent, if China's managed to have or smoothen the growth profile, but at the same time manage to continue to reform the economy, especially with some of the growth drivers got to be changing. As Ambassador Wang also talked about, this innovation is one of the important sources of growth. Then China really needs to boost the total factor productivity, which means that we're more concerned about the content of growth rather than the actual GDP number. That's probably not a good representation of the economy anymore. If you turn to the next slide, please. Then I can tell you, one of the biggest structural impediment to Chinese growth is population aging. The demographic profile simply cannot support China growth anymore unless China is able to improve the total factor productivity, which means that the per person output per labor should increase in order to sustain economic growth, and also to make the growth more sustainable. That is why besides growth, besides GDP, I think all over the world, other central banks are now concerned about inflation. That's probably due to the supply side constraint. So to some extent, how to address the supply side constraint is also an important aspect of China, and this is very important in terms of trading relationship with other countries, especially for New Zealand as well. Secondly, is this population aging itself is probably the biggest drag to the local economy in a sense of the property market. If you look at Chinese growth in the past 15 years, it's more a property economy, and the boom and bust of the property market usually drive growth. Not to say about the manufacturing side seems to be okay despite the COVID lockdown. Actually, the export number of China has been doing very well in the last 2 years, and also in the past few months too, despite the Shanghai lockdown and some of the disruption of the logistic and port activities. But overall, we do see that the external side of the economy is doing okay. And President Xi Jinping overarching policy of the economic development is called dual circulation, which means that China really needs to develop the domestic market. At the same time, to use the domestic market leverage on the international relationship. And that is how they call the dual circulation. One is the domestic circulation, the other one is the external circulation, so that both engines can work and improve growth and make the growth more sustainable. The reason I'm linking this dual circulation to the aging population here is that if you look at this slide, that the Chinese working age population share of the total populations has already peaked and actually has been falling in the past few years. By my very simple extrapolation, it's no fancy econometrics, even though I had my dissertation in econometrics 30 years ago here in Toronto. But I don't really need to have a very sophisticated econometrics model can tell you that in 15 years' time, the working age population share of the total populations will approach the world average. And that is alarming, you know, in terms of how the global supply chain regulates itself, because we talk about the largest labor force, you know, the pool of labor force started to shrink. And the only way for China to sustain growth is to improve the output per labor, so that would not drag the external side of the economy at the same time the global supply chain activities. And in the longer term, you know, by the middle of the century, Chinese populations, in terms of working age population, the share of the total population will also be hitting the US level. This is, I think, is a magic number. You know, this time exactly the same time frame of President Xi Jinping new era. You know, talk about the vision 2035, and then the middle of the century. It's exactly the inflection point of the working age population in China in terms of share of the total population. So this is I think this can tell you how the economic regime need to accommodate the demographic challenge over the next 15 years and also a longer term. And to improve the total factor productivity means that China will have to get a higher wages, you know, to per labor. Because if you don't have an improvement in productivity, then how can you boost consumption? Consumption is probably the biggest growth driver over the next 10 to 15 years down the road. But the only constraint to constrain the Chinese consumer is whether they continue to have a consistent wage growth. And that's really rely on whether the productivity gain can match the wages. And that's how other economies have gone through, you know, in the 80s or 90s, you know, the political dragon in Asia and many other emerging markets have experienced some sort of wage growth, but to some extent, some other economy would not be able to break this so-called middle income trap. And the wage gets stagnant, and then they could not grow and sustain their growth, so that they continue to become developing economy of emerging markets and could not, you know, join the rank of OECD or advanced economy. And Chinese policymakers knows about this, and that's why in the past 5-10 years, China has placed a lot of emphasis on innovation and technological development. And that has a strong implication to China trade policy. If you turn to next slide, that is a quick summary of the trade policy. Basically, what I'm seeing in terms of the regime shift is that in the past, whatever you produce, China will buy it. But from now on, especially under the new, you know, geopolitical regime, I believe that the emphasis will be more on security. For example, food security, energy security, and also chip security. I'm talking about chips here is semiconductor, not fish and chips. I'm talking about the integrated circuit, which is probably the most important importing item of China. And every time I go to Australia and talk to clients, I ask them, you know, what's the biggest importing item of China? They all say iron ore. You know, they think that China imports more iron ore than integrated circuit, but that's not true. Look at the data. The top three are energy or crude oil, IC, and agricultural product. You know, this is food security is a very important item Chinese policymaker pay attention to. In the end, everything or every day, I believe the Chinese leadership is thinking about how to ensure, how to feed the 1.4 billion population. That is the top agenda every day in the past few decades. So I think over the next few decades, this will continue to be a very important aspect of China. And that is why I don't believe in the story of deglobalization and decoupling, especially from a Chinese point of view. Whether other countries want to decouple or deglobalize is another story. But as far as I can tell, this is not an assumption of the Chinese policymaker. What China wants to do is continue to cooperate with other countries, develop strong economic tie and trade tie with other countries, so that China can ensure some of the strategic items concerning food security, energy security, and even chip security will not be disrupted, because this is so important to sustain China's economic growth. China cannot produce everything. China may be a great, manufacturing of the world biggest factory in the world, but China cannot produce everything, especially for some of the items that China does not really have competitive advantage in producing those items. Now, of course, that this climate change or zero emissions will continue to be the major agenda of President Xi Jinping. But in the short run, China continues to import energy from the rest of the world. Even though Chinese agricultural production in the past few years in terms of harvest, the output has been very strong and very stable. But Chinese producer cannot fit, is not sufficient to feed the whole country. That's why China will continue to import food and especially dairy from New Zealand. So I'm not worried about the trading relationship between the two sides, but from Chinese point of view, we'll continue to be very committed to the import, from New Zealand. Why don't I stop here? Otherwise, I will continue to talk, and I won't have time, for Andy, or I won't have time for Frank to ask me questions. Why don't I stop here? And over to you, Frank.
No, thank you very much, Raymond. And I think you did answer one of my questions there, which was about the impulse towards national security, and that particularly around food security. But you have basically said that New Zealand food should still be in demand in China.
Correct.
Good
Especially if the hypothesis that I have is that China will continue to boost productivity growth and wage growth. We'll see some breakthrough and continue to increase their consumption appetite. Then in the end, China will need to import more quality product and produce from the rest of the world. If you turn to the next page, of course, that's this.
Yeah.
And let me share with you, next page is this called disclaimer, which means that what I'm telling you may not be correct, may be wrong, but always of this has this piece of disclaimer. But what I'm seeing now is that China will continue to demand for quality agricultural product from the rest of the world.
Thank you so much. I'll now bring Andy into the conversation, and it's my pleasure to introduce Andrew Browne, known as Andy. He's a partner in Brunswick Group, which is one of the world's leading critical issues advisory firms, where he advises global companies now on China strategy. Andy served in senior roles at top-tier news publications for many years. Most recently, he was editorial director of Bloomberg New Economy Forum in New York. And prior to joining Bloomberg, he spent 35 years in Asia, latterly as China editor and economist for the Wall Street Journal, where he won the Pulitzer Prize for international reporting as part of a team covering China. Andy also speaks to us from North America, but from New York, on what it means to be a global business investing and trading with China. Over to you, Andy.
Thank you, Fran. I'm mortified that I'm not actually in New Zealand with you. That I'm coming to you from Brooklyn Heights, New York, which is not known as a great China watching hub. But it's not a bad place, not a bad perch from which to observe corporate America. Wall Street is behind me right now across the East River. My disclaimer before I start is that I am not going to bring the same level of statistical analysis and specificity to my presentation that we heard from Raymond, and I could listen to Raymond going on for 24 hours. He's outstanding. My presentation is going to be much more impressionistic, anecdotal. I'm going to try to give you a flavor of what I'm hearing from US and global businesses who are operating now in China. In my last job, as Fran, as you noted, I ran the editorial operations of Mike Bloomberg's New Economy Forum. It was a CEO platform for East-West engagement. We had several hundred CEOs, all of them interested, engaged in, concerned with China. So look, this has been 2022, one of the most difficult years that foreign businesses in China have experienced in recent memory. Events have challenged what global corporations knew, or at least thought they knew about the country, and about how China works at a really quite fundamental level, starting with growth. You know, the business community extrapolated that high-speed growth into the distant future. And one can see why. In February, I was in Beijing at the Winter Olympics. I was doing the China commentary for NBC. And on one of the shows, one of the anchors, Mike Tirico, he said to me, Andy, how do you compare China today in 2022 with China in 2008? In 2008, of course, is when Beijing hosted the Summer Olympics. Beijing is the only city in the world that's hosted both Summer and Winter Olympics. And I said, you know, Mike, the first thing to know is that back in 2008, the Chinese economy was a little bit smaller than Japan's. And today, it is 3 times the size, okay? Which is another way of saying that in 14 years, China added 2 Japans. And Japan, as we all know, is the world's 3rd largest economy. And during the same time, it became the world's largest manufacturer, and it became the world's largest exporter. Back in 2008, businesses were asking questions like, can the Chinese innovate? Today, here we are, China is a technological superpower. And in just about every technology that's going to drive the 21st century economy, from artificial intelligence to quantum computing, China is catching up with, or has drawn level with, and in some cases has overtaken the United States. That is the context in which businesses for so many years have understood China. You know, growth this year has hit a wall. Raymond noted expansion in the second quarter was 0.4% by official count, probably true. There's no way China's going to meet its 5.5% growth target for this year. To do so would require a miracle of growing 8% or so in the second half. Not going to happen. Certainly not going to happen with zero COVID. And unusually, the government is not pumping like crazy as it did back in 2008. The leadership appears to have come to terms with the reality that the current economic growth model has run out of gas. And pumping in the normal way, which is to say, investing in infrastructure and real estate, is merely going to add to China's mountain of debt. And President Xi Jinping has very wisely prioritized, as Raymond notes and the ambassador noted, quality growth over quantitative growth. If that is the case, we are clearly looking at much slower growth in China going forward. People talk about Japan's lost decade as it worked out the bubbles from as it worked out the excesses from its own bubble years. And it's worth remembering that Chinese imbalances today are even more extreme than Japan's were back in the late 70s and the 80s. Unlike Japan, of course, China is still a developing economy. Premier Li Keqiang himself noted some time ago that 600 million Chinese people survive on an income of 1,000 renminbi a month, which is about $150 US. The takeaway for business here, there is a rethink of China going on in the C-suite, in boardrooms, in the US and elsewhere in the West. It does not mean that companies are pulling out of China, not at all. It does mean that companies are thinking about what they're prepared to give away to get in, and once they're in, to stay. You know, global business, as I say, has always been a bit breathless about opportunities in China. Back in the day when Disney was weighing its investments in a Shanghai theme park, the then CEO, Bob Iger, said that he thought that China represented a bigger opportunity for Disney than when Walt Disney himself was buying land in Central Florida back in the 1960s. You know, that deal that Disney struck with Shanghai to get in reflected its belief in a growing Chinese economy. And that was reflected in the terms of the size of the investment that went in, the IP that Disney was prepared to put in, the revenue share that it was prepared to give away to its Chinese partner, the management control that it was ready to give up. I think the slowdown is starting to scramble that sort of calculation. And at the same time, companies are looking at opportunities elsewhere, geographic opportunities and opportunities within their business. If you look at Disney right now, they're making big bets on streaming, Hulu, Disney Plus, ESPN Plus. None of those brands are allowed to operate in China. Movies in China are touch and go. You know, a frame here, a frame there that upsets the censor, and your film doesn't get in. You know, this is the issue. It is that, in a sense, businesses are right-sizing China opportunities. They're taking a more rigorous, one might say, a more realistic view of where the country is going from a growth perspective. Second point, governance, big issue, huge issue. China's growth, the explosive growth that I was talking about, that took China in 14 years from one Japan to three Japans, was the product of incredibly smart, thoughtful, careful, well-sequenced, and above all, pragmatic policy making. It was a bottom-up process, and it relied on local officials who were party officials, very inventive, fighting for their communities, experimenting, being bold in their experimentation, and being allowed, having the leeway to experiment. They tried things. It didn't work, stop doing it. It did work, the model can be extended regionally, perhaps to the entire country. The way that businesses talk to me about China today, all that seems to have, or a lot of that seems to have flipped. Policy making is experienced by foreign businesses in China these days almost as a series of thunderbolts from on high. They reverberate from the top all the way down through the Chinese economy to the grassroots and prompt a considerable amount of confusion, pushback, concern, and in some cases, panic. Now, that may be a gross oversimplification of the process, but I don't think it is an exaggeration. Take real estate. So, real estate was described by an economist, I'm sure Raymond knows him, Jonathan Anderson, used to be the economist at UBS. He once described Chinese real estate as the most important sector in the universe. And the mandarins in Beijing determined there were 3 red lines that property developers in China could not cross. The idea was in terms of debt. The idea was to squeeze excesses out of the property sector. President Xi Jinping has said houses are for living in, not for speculation. Very wise. Not that original. Premier Wen Jiabao has said that in the past many times before. And the idea appeared to be to shock those debt delinquents who were unbalancing the whole sector. They talked at the time about a controlled explosion. It seems now, when you look at what's happening to the real estate sector in China, that they've just taken the pin out of the grenade. The entire real estate sector in China is now junk in the debt markets. The crackdown on real estate has affected good developers like banking, and it has affected delinquent developers like Evergrande. Did policymakers understand that this was going to be the implication of their crackdown on the real estate sector, which was a really, really big call? Now you have a situation where homeowners who bought apartments that haven't been built, their real estate developers have defaulted on their debt, they're not completing their the construction of this property, they have gone on a mortgage strike. This is a protest. Was that considered? Now Beijing is starting to recalibrate, now there's a debt crisis, it's leaking into the financial system, it's starting to look a little bit systemic, and we're seeing a recalibration of policies. There's going to have to be a bailout. Who's going to do the bailout? Well, it's going to be the local governments doing a bailout. How will local governments do a bailout? They don't have much money. By the way, 20-30% of their revenues came from land sales. Land sales were off a cliff, along with housing starts, along with sales. 40% sales in China in July, 40% down year on year. That number came out just a couple of hours ago. The point to make here is that there were a whole set of unintended consequences that came out of this decision to draw 3 red lines. And the most important economic sector in the world today is now in a state of confusion. I don't think that anybody can tell you, really, maybe Raymond can have a go at it. I'd love to hear his views, where real estate is going to be in China 6 months from now, a year from now. Takeaway for business. Again, there are many other examples. I could go on. Like Raymond, I could talk for 24 hours about a lot of these other issues. We could talk about, China's no limits partnership with Russia. We could talk about COVID zero, which is devastating the economy, having all kinds of unintended consequences. What are businesses doing? Again, not rushing for the exit. Foreign direct investment in China in the first 5 months of this year is up, as my friend, the US ambassador to the United States, tweeted out just yesterday. But they're hedging. Businesses are hedging. They're investing in China, but they are increasing their investments at a faster rate elsewhere. They're looking at Southeast Asia. They're looking at India. They're looking at Eastern Europe. They're looking at Mexico. They're diversifying their supply chains, and they're investing more in the United States. The CHIPS Act, which is going to be signed into law by President Joe Biden, most likely this week, it is a big deal. This is the start of industrial policy in the United States. Everybody's playing that game now. The Chinese, of course, have been playing it for a long time. The Europeans, the Japanese, Indians, now the Americans. The CHIPS Act is going to direct $52 billion in incentives to build chip plants in the United States. That gets matched by private businesses, 1 for 3, $1 of government money matched by $3 of private money. You've got a $369 billion climate and tax act bill proposed by Democrats in the Senate. This is an even bigger deal. There's money there for batteries, clean tech, and more. So from a corporate perspective, the investment landscape is starting to fragment. China is not the only game. There's a big world of opportunity out there. The bottom line is this. Back in the halcyon days, businesses looked at China through the prism of opportunity in an almost singular way. CEOs were under pressure to increase their exposure to China. The bigger the China ambition, the better. Nowadays, CEOs increasingly are looking at China through the prism of risk, and they're having to justify their exposure to increasingly skeptical stakeholders, whether that's national politicians, whether that's NGOs, rights groups, human rights groups, or indeed to their own staff. And they're in the business of mitigating risk. I don't know, Fran, have we run out of time?
Yes.
We have. Let me just
that's okay.
give you the way that that businesses are telling me, talking to me about how they're responding to all this in a sort of a macro, again, rather impressionistic way. It seems to me that businesses are going three ways on China. A very few are exiting. We've had some examples of that. LinkedIn, Airbnb, Kindle, Amazon's Kindle. These are companies that looked at the China market. They said, we're not doing very well. We've got a big reputational risk by doing business here. We're just going to cut our losses, cut bait, and get up. A very, very small number are doing that. A much larger number of companies are deciding that they're going to have to go all in on China. We've seen that before. Young China, for instance, where global companies hive off their China operations and in a sense sort of put a wall around it. Make it self-sufficient, bring in new investors, set up new corporate arrangements. I think it's quite likely that some of the German car makers are going to go down that road. Back in the day when, German engineering, consumers in China, they loved the German, drive chain, loved German engineering, loved the German brands. They dominated the combustion engine part of the market. These days, it's all about electric cars, EVs. It's about software. It's about communication, high-speed communication. It's about culture. It's about content. It's about entertainment. It's quite likely, I think, that German car makers who now owe so much of their 60-70% of their global profits from China are going to actually turn into Chinese companies. I think by far the largest set of companies are going to stay and they're going to hedge. Look, China is going to be an increasingly important part of life for the corporate world. Why wouldn't it be? It's going to be one of the largest, maybe the largest economy in the world. Quite likely it's going to overtake the United States. It's going to be a font of innovation. It's where, consumer trends increasingly are going to be set. Companies need to be in China. They want to be in China. They want to engage more with China. At the same time, what I'm hearing them say is, what is my plan B? What is my plan C? What happens if it all goes wrong?
Thank you. That's amazing. We don't have much time, but I think, Raymond, would you like to pick up on some of the points Andy made? I mean, you've listened. What do you dispute?
No, not really dispute. I think what I'm seeing from the data-wise is that even though anecdotally everybody is talking about pulling out the investment from China, especially after Shanghai lockdown, expatriate, they had hard time in Shanghai, locked at home for a long time, and some of the thought that people are talking about the MNC will be moving out by some of the survey by Chamber of Commerce in Shanghai and Beijing too. But look, if I look at the data this morning, that's my boss, Richard Yexinger asked me, reviewing the FDI number of China. Actually, the FDI, the foreign direct investment number, was up by 24% year to date. Was up, it's not down. That's very interesting. And I look at this number, actually, what I see is that 33% of the FDI is going to high tech, as Andy alluded to, is the tech and innovation that drive foreign investors China. And actually, what I spoke to some of the VC, venture capital, and PE, they are actually pretty bullish about investing in China on the tech side. I think that from now on, even though I'm talking about regime shift, and it seems to me that the total FDI of China might have peaked, but I won't use it to characterize the Chinese FDI outlook. Is that the Chinese FDI is much more focused, and that's exactly what the economists want to, or the policymaker want to boost the economy, is to moving towards the tech and digital side of the economy. These investors, they invest a lot in AI, they invest a lot in chips productions, and they invest a lot in EV, the electric vehicle. These are exactly what the Chinese policymakers want to boost, and to become not just a smart city, but a smart country. Think about that. If China become a smart country, that's the big thing in the world.
I think both of you have talked about the impact of COVID, and what is the sense of what will come out of the National Congress later this year? Do you think we'll see a pathway then, after that, toward reopening? That's a question to you both.
Andy?
I think it's really difficult. I don't know what the exit is. I think the leadership have really boxed themselves in here. And look, one can see the underlying logic for zero COVID. And ironically, as a result of China's incredible success against the first wave of COVID, you have a population that has now virtually no immunity to COVID. At the same time, the Chinese vaccines are not bad, but they're not world class, right? They're not mRNA. And one can also see it from the perspective of the healthcare system in China, which of course is world-class in China's leading cities, but when you get into rural areas, becomes quite rudimentary. So if you go, if China was to go, as it were, full Florida, just let the thing rip, no face masks, no nothing, it would be a disaster. On the other hand, this extreme zero COVID approach is the opposite of the pragmatism that I had seen and we all had seen in China for so long. I was listening to a Chinese economist. I was reading a transcript of a Chinese economist talking about this just yesterday or the day before. And he said, this is actually anti-science, okay? It is not science to say you can beat Omicron. You cannot beat Omicron. You're going to have to learn to live with this. Whether that's going to be possible or not, I don't know. Part of it is linked to domestic politics, that the party has linked its legitimacy, its credibility to maintaining COVID zero, and partly is geopolitics. This expression that our ability to our people's war against COVID demonstrates the superiority of the socialist system over the U.S. system, the system of capitalist democracies. I don't know. Maybe they declare victory over COVID and decide that Omicron deserves a different kind of battle. In the end, China's going to have to learn to live with it, like the rest of the world.
Raymond, do you have a view on that?
No, I don't have anything to add. Look, I think the Chinese COVID policy is not simply an economic issue, but a political issue too. And I represent ANZ Bank. I don't want to express any political view about China. Thank you.
I understand. One of the questions from the audience here, and I think it builds on the issue you talked about national security, as in not military security, but there's growth and preference for local brands and patriotic consumption in China. And what does this mean for New Zealand companies? And both of you have been here and studied New Zealand companies exporting New Zealand brands to Chinese consumers.
Andy, you want to go first?
Yeah.
Well, I would just say that I think New Zealand exports have a great prospect in the China market, as the ambassador pointed out. They're high tech. Of course, on the food side, China buys from New Zealand because it's the right quality product at the right price, and it's particularly when you look at a product like milk powder, it's underpinned by strong New Zealand values, which themselves are supported by institutional arrangements. I think New Zealand needs to have confidence in its ability to compete in China. At the same time, I think, like every other country in the world, New Zealand needs to be thinking about diversifying its export markets elsewhere.
On my side, I'm not worried about the branding effect of New Zealand. Look, 1/3 of the export to China is dairy, 16% is meat, 15% is wood and log and forestry. And I don't think that China can brand this. All these items are probably replaceable, from the Chinese point of view. 50% of Chinese imports of dairy are actually coming from New Zealand. And it's not about branding, it's about whether China has a comparative advantage to produce these type of strategic items, which at the moment I don't see that China has a comparative advantage in those items.
Any final thoughts before we have to wrap? Andy?
New York.
I'm good, Fran. Great. Thank you for having me. It's great to be with you. As I say, I'm only sorry I couldn't be there in person.
Yeah, it's a great shame that our first trip out of the US, where you could have come without having massive issues getting in, only actually arrived at about midnight our time last night. But I'm sure for both of you, we look forward to seeing you down in New Zealand, where we can talk at more length. But thank you so much for giving up your time on your Sunday, and look forward to seeing you both in the very near future. Thank you.
Thank you.
Thank you.